Very good morning to you all of students. So today we will be continuing our discussion on the portfolio management. So in the last session, we concluded our session on efficient frontier, and just before that, we have studied the portfolio risk and returns. And portfolio risk we were studying from the point of view of Markowitz portfolio theory, which is MPT. This one. In this, we have covered for two securities, and I have said that more than two securities will be covered later. So now let us first start with how to calculate a portfolio risk in case of more than two securities. So, for example, we have three securities with the name of A, B, and C. Similarly, so the best part of this approach is this is just a matrix approach, and you have to just plot all the three securities in the both rows and columns. Okay, then as per the question or as per the requirement, we would already be given that what would be the weight of A, weight of security B, and weight of security C. Similarly, here also I will plot the same thing: weight of security A, weight of security B, and weight of security C. And the only part here in terms of the calculation is that we just have to take the covariances between this cross. So let's say here we will take covariance of A with A, which is nothing but the variance, correct? Because as I told you in the earlier class, covariance is between two series and variance is between the same series, correct? So I can write it as variance and multiply it by WA, which is this row, and WA by column. So if we multiply these three things, we will get A by A result. Then similarly on B and A, which means here we will have to take covariance of A and B multiplied by weight A and multiplied by weight B. Right? Weight A is for the rows and weight B is for the column. Similarly, for A and C combination, we have to take covariance A and C, weight of A and weight of C. Okay. Similarly, now again coming to the second row, which is B row. So BA is covariance BA, weight of B and weight of A. Correct? And simply here also covariance of B and B, which means variance of B, correct? We can also write this as variance of B multiplied by weight B, and in column also it is weight B. Now coming to the last part, which is B and C, this is covariance BC, weight B, weight C. And similarly, last line, C and A is covariance CA, weight C, weight A, covariance CB, weight C, weight B, and here we will say covariance CC, which is variance C, correct? Variance for C series multiplied by weight C, weight C. I hope this is very clear and very easy. And then we have to take a summation horizontally as well as vertically. So we will take summation here and then add above formula. I can just rewrite the formula by replacing all the covariance AB by correlation coefficient multiplying the respective standard deviations. Okay, students, I hope this is clear. So now it depends. Whatever easy part is given in the question, you can adopt either to the covariance or you can say the correlation coefficient. Okay, so I'm just writing here A, B, C, similarly A, B, and C. This is again weight A, weight B, weight C, weight A, weight B, weight C. Now, what we have to start is correlation coefficient between AA, which is always 1, right? Standard deviation of A, standard deviation of A, both for rows and columns, and weight of A, weight of A. This is the first for A to A. Now A to B is RAB, standard deviation of A, standard deviation of B, weight A and weight B. This is for RAB. Simply here will be RAC, standard deviation of A, standard deviation of C. Sorry, this is R. Correlation coefficient between A and C, standard deviation of A, standard deviation of C, and weight of A, weight of C. Okay, simple to this, we can write the other notations and take the summation and do the horizontal and vertical summation both to arrive at the portfolio variance. Okay, so these are the two ways of calculating it in case we are given the covariance also, and in case we are given the R as well, which is the correlation coefficient. Okay, students. Now let us go to the next part. We will solve the questions to understand this better in the further part of the session. Now let me go to the second portfolio theory. So this is again the two securities, more than two securities is given under the Markowitz portfolio theory. Now let us come to the new part, which is called as Sharpe's index model. This is also called as single index model. Let us first understand what does this model says, and then we will compare both Markowitz and this model to understand better that what are the two objectives of both of them. Now, this again is, see, till now also we are everywhere we are discussing about the risk and return, whether it is a security or whether it is a portfolio or whether it is any particular type of a study. So this model also suggests that to calculate the return and risk, so it gives you a thought process how to calculate a return. So this model says that return you can always dissect into two parts. One which is caused by the macro factors, and one which is caused by the micro factors. Correct? Now, what does the macro factor here means is that for those factors that impact the overall economy. Correct? Now, for example, the market, the return in market is a return for the entire market because those returns are influenced by certain factors which we have studied while studying the systematic and unsystematic risk. Correct? So what does it say is that the return you bifurcate into two parts. The first part for macro will be that you just simply take the return of market and adjust it for beta. So beta multiplied by the return of market. See, in the previous session, what we have studied, what is beta is? Beta is the sensitivity of returns of a particular security in relation to that of a market. Now we have also studied if beta is 2, that means if the market fluctuates by 1%, the particular security will fluctuate by 2%. Correct? So beta is nothing but the relationship between the returns of a security and the returns of the market, which is the sensitivity of returns. So what they are saying is you take the retailer margin as is, multiply it with the beta so as to reflect that what can be expected out of this security. This is from the macro point of view. And from the micro point of view, what they say is, what if tomorrow the market return, which is this RM, goes down as 0? What if tomorrow, if it goes down as 0, still the investor will expect something out of this particular security? So for example, we are talking about here a security. Correct? So this discussion as of now, we are basing on one particular security. So what they are saying is, what single index model says is that if tomorrow the market return, which is RM, goes out as 0, then this entire thing will become as 0, but still investor would expect something which is called as alpha. alpha is very much a constant number that will be expected irrespective of whether what is the return in market. And the third thing which an investor would expect out of a return from the security is he will also say that, see, I am covered for the systematic risk through here. I am also covered if there is no return, then what would happen is here. But where I am covered for the unsystematic risk that the security is having, because you would recall in the previous session you studied that risk is classified into two parts. One is systematic and another one is unsystematic. Correct? So the investor will think that where I am covered for the unsystematic risk that I am additionally taking. So hence there is a EI again, small constant that will be added which will act as a return for unsystematic risk. This is a return for unsystematic risk. And this is if RM is equal to 0, then what minimum return is expected? Okay, students. So this is what the Sharpe index model says, and it says that finally you have taken this 1, 2, and 3, add all of them, you will get the total return expected out of a security. So hence I'm just consolidating it here. So let's say return on A, if we are talking about a security which is A, is equal to alpha of A plus beta of A multiplied by RM, which is the return in the market, plus EA, which is the return for unsystematic risk on account of security A. Very easy and very simple and very logical. So this we have to remember that this is the formula given by the Sharpe's index model. Okay, students? Students, please do ask questions wherever you feel there is some doubt. We would be really happy to answer that. Now the second part is risk. Now in case of risk also, the model says, let us divide the risk into two parts. The same thing, one is on macro factors and second one is on micro factors. Now, if you see again, macro factors is from the point of view of the entire market, correct? So what it says is that what is the risk in market? What is the risk of market? The risk of market is standard deviation of market, correct? That's what we have also studied. So if standard deviation of market gives the risk of market, can anyone tell me that what is the relative risk of a security if we say that the relation is to that of a market? Wherever the relation of a security comes to that of a market, we use beta. Correct? So what we say is if we multiply beta into the risk of a market, it would mean that it will give us the systematic risk for the security. The only thing that we have to remember here is that since we are talking about risk, first we always calculate it on a square basis because of the logic that we discussed, and then we finally take a square root. So hence, on a macro factor, we are taking beta square multiplied by standard deviation of market square. So this will give us that what is the systematic risk in the security. Okay. And on micro factor, which is the unsystematic risk, it will be standard deviation because of the unsystematic factors. So this is the unsystematic factor related standard deviation square. Okay. Now this is what the risk is. Now they also say that you just take 1 and 2, add both of them, you will get the total risk. So variance, as of now I'm putting here as variance is equal to beta square standard deviation of market square plus standard deviation on unsystematic risk square. If we have to take the standard deviation, we will just take a square root. Okay, students. This is what the security return and risk is. Okay. Sairam is asking, sir, can you give the brief background, this theory for better understanding why this concept came into the picture? I think Sairam, that's a very brilliant question because we have to see it from why we are studying different model. Give me just 5 minutes. Let me cover the portfolio part of it as well, and then the difference will be visible to all of you. That why this concept is coming. Okay. Definitely, we will come back to your question, Sairam Delhi. Okay, so the security return and risk is very clear, correct? Now, how does the portfolio risk and return comes up? Now, again, as per the same index model, now there is a portfolio risk and portfolio return. Here we'll take return, here we'll take risk. Okay, now for return, what they say is you just take the weights and multiply it with the individual security return. The weighted average is the portfolio return. Very simple, very easy. So the return on portfolio will be summation we will put later. So weight multiplying it by the individual return. Okay. And where I is equal to 1 till n. So what you have to take here is you have to multiply each and every security. Let's say there are 4 securities. Take the individual returns as per this model, which is this, multiply it with the weight and take a summation of that. That's very easy and very simple. Okay. Now, sometimes in this, the question also extends and asks us that what is the portfolio alpha? So this is called as alpha, right? As we have seen here, alpha is what? Alpha is the minimum expected return which an investor would expect even in case the market return is zero, correct? This is what alpha. So sometimes the question can ask you what is the portfolio alpha. So portfolio alpha is nothing but the weighted average portfolio, weighted average of the individual securities alpha, correct? So this is summation I is equal to 1 to n, weight I and alpha I, simple. So we'll take for all the securities, multiply their alphas with the respective weights and take a summation of it. Sometimes the question might also ask you what is a portfolio beta. This is even a very simple one to calculate. We will just multiply the weights in betas of the particular securities, take the summation of it, and this is what the portfolio beta is. Correct? So it's just a simple multiplying with the weights and adding them is the return, and within the return, portfolio alpha and portfolio beta. Now let's come to the risk. Okay, risk I am putting here. So what does this theory say on portfolio risk? So this is a standard deviation of portfolio square, which is portfolio variance I am putting here. So it says is that you just take the weights, multiply it with the both the factors that we have taken. Okay, so if you see here, one is the standard deviation on unsystematic risk, and this is the macro factor related risk, which is beta square into standard deviation of market square. So we have taken both the values as is, multiplied the weight in both of them, but remember to multiply it with weight square. Why? Because these all numbers are in squares, the beta square, standard deviation of market square. But this logic also we have already seen, and I will relate it to why we are multiplying it with a square, and then just take for all the transactions I till 1. Okay, students. So now if you see, this is the portfolio risk as per the Sharpe's index model. For beta I, weight I square, we will multiply it in the standard deviation of market square. Now, here comes the difference, that why is this model relevant for us, or why even we are studying this model. See, the answer actually lies in the comparison between both MPT and Sharpe's index model, which is SIM. Okay. So if you see, students, in Sharpe's index model, I would be really happy if some of you can also tell me what are the observations that you have seen in both the theories, in MPT and SIM specifically. Let me also start with what I feel, and I would be very happy to hear from all of you. See, what MPT says is that you have to, while you're talking about portfolio risk, you have to always bifurcate. Let's say if it is two securities and more than two securities. Wherever more than two securities is concerned, you have to either have the covariance between A, B, B, C, C, D, or whatever is the combination that is there, or you need to have the correlation coefficient, which is again calculated using the covariance, correct? Either you need to have the R combination, or you have to need to have the covariance combination. But if you see, it will ask us to calculate a lot of variables, correct? Because you can imagine the kind of variables that we will calculate. But in the Sharpe's index model, if you see, we just need the respective betas, the respective weights, and the respective unsystematic risk. That's all. We don't need any operation on joint variability, any operation on correlation coefficient, any other thing is not required at all in the Sharpe's index model. So hence it is also called as single index model. It is also called as single index model because the single index on which the return and risk are based is the market index, correct? Because your return is also based on the return of market, and here the risk is also based on the risk of market. That is what the biggest difference between both of them is. Single index model is relatively very simple because you have to deal with a lot of less variables. But modern portfolio theory, on the other hand, having a lot of variables calculation, which involves covariance, correlation coefficient for the total number of securities that we have. Now you would have seen in this just the matrix approach that we have solved. For calculating the three securities portfolio risk, you have to do calculation 9 times, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. For all this, you have to do the calculation, and for all of them, you first need to have the correlation coefficient in place. Correct? For all the combinations, you need to have correlation coefficient. Hence, this process is very complicated. On MPT, to simplify it, the need came for SIM, which is Sharpe's index model. I hope, Sairam, this question is answered. Okay. Now let us go to the question number 7. So this is again from the same assignment that we were discussing in the earlier session. Okay, so Naveen is asking that in single index model, there is no correlation between securities. Then how come diversification will work? So good question, Naveen. I think all of you are thinking on a very good lines. So to answer your question, Naveen, see, definitely the diversification factor, we can say that the R and covariance between A and B, the covariance or correlation coefficient, is a very good calculation to depict it, correct? But if you see, already we are taking here the market standard deviation. In the market standard deviation, already the diversification, the non-diversification, all the risks with the proper calculation are already considered, because market is what? Market is collection of all the portfolios, right? Market is one such portfolio which have all the portfolios. So this will include everything, and this we are multiplying it with beta, so that it means it is in relation with beta. The moment we do that, we say that if market standard deviation is 10, correct? If market standard deviation is 10 and the beta of my security is 1.5, so I can expect that the standard deviation or the variance for my security is 15 on a rough calculation basis, I'm saying. Correct? Only on account of the systematic risk. Correct? This is only on account of the systematic risk. And to bring in the factor of diversification within the portfolio, there is an unsystematic risk that is being added. Correct, Naveen? So Sairam is asking, answer may be different. Now, yes, Sairam, that is very much possible. Between both of them, the answer can be different. Correct? Because both of them are based on a different ideologies. Okay. Now let us move to question number 7. Now question number 7 says, very good question. It will revise all the concepts that we have done till now, all the formulas, all the calculations till now. So yeah, let's start. A study by a mutual fund has revealed the following data in respect of 3 securities. Now, till now, all the questions were on 2 securities. Now, this is the first time that we are seeing a 3 securities question. Okay. So, for all the 3 securities, we are given that what is the standard deviation, what is the correlation with index PM, correct? That means correlation with index. Correlation here is what? The correlation coefficient, which is R. R of, let's say this is R of A with the market, this is R of B with market, and R of C with market. So they're saying correlation with index PM. Now the standard deviation of the market portfolio is observed to be 15%. They are also saying that apart from these data, you are also given 15% is the market standard deviation. What is the sensitivity of returns of each stock with respect to the market? Now, first of all, they are asking sensitivity of returns of each stock. Can anyone tell me what is this? I'm waiting for all of your answers. Please do respond. What is the sensitivity of returns of each stock? This I have already discussed multiple times in the session. What is the question asking us to calculate? Please do respond. So, let me read out the question further. Meanwhile, you guys are responding. Then, what are the covariances amongst the variance stock? Now, the second part is asking the covariance that we have also studied in the first session. What would be the risk of a portfolio consisting all 3 stocks equally? Now, here we are required to calculate the portfolio risk. Okay. Now we have 2 approaches: modern portfolio theory and the Sharpe's index model. And the fourth part is what is the beta of portfolio consisting. Beta is asking and total unsystematic and systematic risk. Okay, now Naveen is saying it's beta. Perfect, Naveen. Sensitivity of returns of each stock is beta only. So in first part, we have to calculate beta. Okay, perfect. Sairam, required rate of return is not the sensitivity of returns. What they are asking is, what is the sensitivity of returns? Sensitivity of return is beta. Now, if you see, while studying beta, see, this is the beta. See, I have mentioned here sensitivity of returns of a security in relation to that of a market. Okay, students. Yeah, so solution, first of all, for calculating the beta. Okay. So for calculating the beta, we know that beta is calculated by the correlation coefficient between that stock and that market multiplied with the standard deviation of stock and standard deviation of market comes into the division. Okay. This is what the formula for a beta is as per the correlation technique, correct? We studied two techniques, correlation and regression. As per correlation, this is the formula. Now, for security A, these all data are given. 0.60 is given as R between security A and market, multiplying it with the 20, which is the standard deviation of the security, divided by the standard deviation of market, which is 15. 0.80. Now for B, it will be 0.95 multiplied by 18 divided by 15. This standard deviation of market will remain same, correct? Because in whatever security you take, standard deviation of market will be same only. Again, R between C and market multiplied by standard deviation of C, which is 12, divided by standard deviation of market, which is 15. So this comes as 0.60. Okay, so the first part of the question is done. Second, they're asking to calculate the covariances among each stock. Now, students, if you note, you have both. Now for calculating the covariance. Okay, now we have studied that how can the covariance be calculated. See, you need the R between AB, BC, CA, correct? That's the all combination you need R for calculating the covariance. Do you have that in this question? No, right? Because in this, the correlation is what we have with the market, correct? So while studying the beta, we also studied that covariance between A and B is equal to beta A, beta B multiplied by the variance of market, correct? So covariance A is equal to beta A, beta B, multiplying it with the standard deviation of, multiplying with the variance of market. That's how we can calculate it. So applying the same thing here, A, B, and C, A, B, and C, we can just put the respective betas here, 0.80 that we have just calculated in the above step, 0.60, 0.80, 1.14, 0.60. Okay, so between A to A, it is, see, already A to A covariance is nothing but the variance of A, right? Because for a single series, there is no covariance, there is always a variance, as I told you. So this is, we can put 20 square simply, because we will have to do 20 multiplied by 20 here. Then here it comes 0.80 beta 1. What is the beta 2? 1.14, multiplying it with the market standard deviation square, correct? Similarly, here it will be 0.80, 0.60, 15 square. Simply here it will be 1.14, 0.80, 15 square, 1.14, 1.14. Sorry, this is B to B, right? So B to B will be the standard deviation square, which is the variance, correct? Which is 18 square. Here it will be 1.14, 0.60, 15 square. And similarly, here it will be 0.60, 0.80 multiplied by 15 square, 0.60, 1.14, 15 square. And lastly, it will be 12 square, correct? Because for C to C, the variance is the covariance. Now, finally, writing the answer. So the covariance is between A and A is 400. After solving the above equations that we have, 205.2, 108, 205.2, 324. B and C will be 153.90. C and A will be 108, 153.90. And here it will be 144. Okay, students. So this way we have calculated even the covariances. So Jitendra, you are asking how to interpret the results, sums and solutions with return. Uh, can you please elaborate your question, Jitendra? If you're asking on some specific question or some specific solution, otherwise the interpretation is very simple. I'm just telling you on a generic level that it is all purely based on the facts given and whatever the question is asking us to do the operations on those facts. Correct? Now, if you see, you can draw those instances anywhere. For example, now in this question, it is given that the standard deviation is 20, 18, and 12. Correct. So we can definitely think of that A is the highest risky security. Correct. It's carrying the highest risk. Right. But as far as the relation with the market is concerned, the highest sensitive security will come out to be B, which is 0.95. Correct. So, and anyways, we have betas also. As I told you that it will come out as B, and B is the highest sensitive because the beta is 1.14. So these are interpretations you can draw out basis what the concepts that we have studied. So B here it seems to be the highest sensitive. If market goes by 1, B will move beyond 1, which is 1.14. Correct? If still you have anything specific, Jitendra, please do write it on the question handle. Okay. Now the covariances is done. Now let's go to the third part. What would be the risk of a portfolio consisting of all three stocks equally? Now it is giving us the weights. Weight is what? 1 by 3, 1 by 3, 1 by 3. Correct? So which method we can adopt here? I am adopting to solve it as MPT because already we have covariances in place here. Covariance between AA, AB, AC. Correct? We already have. So I just multiply it with the weights and get the answer. So 400 multiplied by 1 by 3 multiplied by 1 by 3, which is weight of A and weight of A. Correct. Then second is 205.2 into 1 by 3 into 1 by 3. Again, for B and A, both of them. Correct. Then 108, 1 by 3 into 1 by 3. Now this is for A and C. 108 is the covariance multiplying with the respective weights. I can put 1 by 3, 1 by 3, 1 by 3 here, right? Now similarly for here it will be 324, 1 by 3, 1 by 3, 153.90. Sorry, I just missed one. Yeah, so here it will be 108 is done, so 205, 324, 153.90 into 1 by 3 to 1 by 3. Similarly, 108 multiplied by 1 by 3, 1 by 3, 153.9, 1 by 3, 1 by 3, and 144 into 1 by 3, 1 by 3. Correct? So multiplying it with the respective weights, the covariances, then taking a summation horizontally and vertically both, we get the answer as standard deviation square is coming as 200.44. Okay, 244. And just to calculate the rest, we will take a square root of 200.244, which is coming out to be 14.15%. Okay, students. So this is what the standard deviation comes out to be as 14.15%. Now the fourth part is asking what is the beta of portfolio consisting of equal investments in each stock. Now we have already studied how to calculate a portfolio beta. Portfolio beta is nothing but a nothing but a weighted average multiplied with the respective weights of the respective securities beta. Correct? So let us put here portfolio beta will be 0.80 multiplied by 1 by 3 plus 1.14 multiplied by 1 by 3 plus 0.60 multiplied by 1 by 3. So the beta for portfolio comes as 0.8467. This is what the beta is. The last part of the question asks us that what is the total systematic and unsystematic risk of the portfolio. Now see, it is asking total systematic and unsystematic risk of a portfolio. See now students, already we have calculated the total risk as per the MPT. We can also calculate the systematic risk as per the Sharpe's index model, and balance will be the unsystematic risk again as per the Sharpe's index model. See, this we have already calculated as per MPT. This we can calculate as per SIM, and this will be coming as a result. Okay, so Sairam is asking how we present answer in exam. So Sairam, see, the best way to present answer is you always go with the sequence in which the questions are asked to you. Correct? So in this case, for example, the first part is asking the sensitivity of return. So we can mention it like this: first, calculation of sensitivity of returns, and then write the formula, put the figures, the facts and figures in that, and then start the individual calculation. Okay, Sairam? So this is what the presentation is on the presentation part. So better to do it like that. Okay. Now the last part is calculation of total systematic and unsystematic risk. Correct? Now we also know that as per, now if you see Sairam, just see this presentation, the fifth part of presentation, I'm doing it as per the proper presentation, as per the single index model. Okay, we know that standard deviation of portfolio square is equal to beta square standard deviation of market square plus unsystematic risk square. Correct? This is what we know as per the single index model. So this is already calculated in part 4 above. Sorry, part 3 above, which is this 200.244. Correct? So 200.244 is equal to beta is already given. The portfolio beta we have already calculated, 8467 square, multiplying it with the market standard deviation square plus unsystematic risk is still there because this is what we are going to calculate. This comes out as 38.942. Correct? The square of this. Now finally, we can put it like this. Total risk was how much? 14.15 percentage. Unsystematic risk. So this 38.942 we have to take a square root because this is a variance and we have to calculate the standard deviation, correct? So it comes as 6.24 percentage. Systematic risk. Now systematic risk, if we solve this, then it comes a systematic risk, correct? And taking a square root of it, which is 12.7 percentage. Okay. So, Sairam, further to answer your question, the presentation in exam will also be given to you at towards the end of this all the lectures. So, CA Ashish sir himself will guide all of you how to take some tips on those presentations and all the things, correct? Which are the common questions around the rounding off, around other things. So, he will guide us better. Okay. Now Jitendra is asking, Sensex, Nifty and Bank Nifty is created with group of security, and if individually security up and down that affect the index, then how to reverse that? Okay. So Jitendra, let me answer your question after this. So what I'm trying to understand from your question is that there are, for example, there is a Sensex, there are other indexes, there can be any index which is definitely having a group of securities in them, correct? Lot of securities, lot of whatever is the now Sensex will have all the securities. Nifty will also have bank Nifty will have only bank related securities, correct? So this is having all the securities. And if individually security up and down that affects the index, then how to reverse that? Okay. Now I think what you're trying to ask is that how the index is getting calculation. So basically, if you see the beta of a index or a market index, the standard deviation, the return, everything keeps on changing, correct? So it's nothing that once the index is fixed, so it is fixed, or once the return of index is calculated, it is going to happen with the same. In practical life, nothing happens like that. For every second the trade happens, all these metrics, all these calculations gets refreshed in terms of the new calculation, correct? So hence, if there is an individual security in this, correct? So let's say security A is part of the Sensex. So security A will move how Sensex moves, and Sensex again will move how security A will move. Okay, Jitendra. So what we are trying to say, see, all these hypotheses, all these theories are based on that since security A is only a part of the entire market. Okay. So definitely security A will have two parts. One is how the market behaves and one is how the individual security A behaves. Correct. But definitely the Sensex will also go up and down basis what the security A is going up and down and how big the security A is for the market to take it up or down. Correct. Because how Sensex is calculated is they will take some base year. For example, I am not too sure what is the current base year. For example, 2010, they will take it as a base year. They will take this as a base price. Now in 2021, if the price, here the base price was 100, here the prices are 1000. So they will see that how is the stocks are moving, and then they will calculate the value of the index based on the weights of the different companies. Correct. So Sensex is actually the reflection of the individual movement of the all the securities. Correct? How they are moving up or down, to what extent. Now Sairam is asking, show question number 4. So question number 4 is the calculation of portfolio beta. This is the fourth part. Show the answer of fourth. So this is the fourth one. I hope you're asking the fourth part or fourth question. Fourth part is this for this question. Okay, students. Yeah. Now let us go to the question number 8. The fourth part, we've just done nothing. We have taken all the betas, multiplied it with the respective weights to calculate the portfolio beta. Now, again, a very interesting question. It says that now, while starting the discussion of this topic as well, I told you to imagine yourself as a portfolio manager. Now, it is also telling you that you, being a portfolio manager, has the following four stocks in your portfolio. One is the VSL, CSL, SML, APL. There are four stocks that are there, and the number of shares are there. The market prices are also given, and the respective beta is also given. Now, compute the portfolio beta, which is the very simple thing. So, we can computation of portfolio beta. Okay. Security, VSL, CSL, SML, and APL. These four securities are given. Now, value of investment, okay, which is the market price multiplied by number of shares, is what the value of investment is. 5 lakh, 1 lakh, 2 lakhs, and 4 lakhs. Okay. Then we can just simply calculate the percentage, that is the respective weight. So here it is 41.67, 8.33, 16.67, and 33.33. All of them should be 100. Respective betas are already given in the question: 0.9, 1.0, 1.5, and 1.2. And this is the weighted beta. Just multiplying 0.9 by this 41.67 percentage. So this comes as 0.375, 0.083, 0.250, 0.400, 1.108. This is the portfolio beta. So hence, portfolio beta is 1.108. Okay. The second part of the question says that if the portfolio manager seeks to reduce the beta to 0.8, see currently what the beta is coming out to be 1.108, which is higher than 1. They are saying that we have to reduce it to 0.8. How much risk-free investment should he bring in? Now, students, please note the risk-free investments always carry a beta of what? Now, let me ask you, if there is a risk-free investment, the beta will be what? I'm assuming risk-free investments to be 0. To be X, sorry. Risk-free investments to be X. Now, students, please tell me what is the beta for a risk-free investment? X. I'm leaving the space here blank for putting the beta. 1 minus X is already we have 1.108. Because if X we are going to multiply it, perfect, Harshad. Harshad, it's saying 0, it's 0. So 0, x multiplying it by 0 plus 1 minus x multiplying it by 1.108, which is the portfolio beta. It should be, total should be 0.80. Okay, now why it is 0? Because risk-free investments are what? Where there is no risk. There is no sensitivity of return with respect to anything. If in market, the return happens to be 13%, 20%, 7%, nothing is going to change the risk-free investment return. Correct? So there is no sensitivity at all. Hence it is 0. 1.108 minus 1.108x is equal to 0.80, because this will all be 0 only. Correct? Okay, then x is equal to 27.79 percentage. So the 27.79 percentage, perfect, Jitendra, 0. Naveen is also saying 0 and Daksh is also saying 0. Perfect. All of you are bang on the point. It's always 0. So x is equal to 27.79 percentage, which is the percentage of total investment that we should invest in a risk-free investment. Okay. Now, to calculate in terms of amount, risk-free, how much is the total amount as per the question? See, already we are holding how much? 5, 6, and 6, 12. 12 lakhs is what we are carrying already. Correct? So 12 lakhs, we should say that this 12 lakhs, 72.21 percentage, which is nothing but 100 minus 27.79. So 12 lakhs we are equating towards 72.21 percentage of the total investment minus 12 lakh. Correct? Because 12 lakh is already he is having. So 16, 61, 820 minus 12 lakh is what the additional investment is required to be 461,820, because the question itself says is, if the PM seeks to reduce beta, how much risk-free investment should he bring in? So that means the question is saying that the investor will bring further investments, correct? Will bring further investments. Whatever is already invested, let it be invested. So 4,61,820 is the additional investment that he should bring in. This is all in risk free. Okay, students. Now the third part asks us to calculate it says that to increase the beta, correct? Now see students, the reduction of beta is very much possible. By what you can do is you can just simply take the weights, correct? And take the risk-free investment in, bring in some risk-free investment, the overall beta will be reduced. But how to increase the beta? Increasing the beta means that you invest more in the portfolio by borrowing on risk-free rate, correct? Then only you can increase the beta. Now let us see how the calculation part will work. Again, we can assume that the risk-free investment to be X. Now if X, we can multiply it by 0. 1 minus X is multiplying by 1.108, which is the portfolio. The overall beta should be 1.2. This is what the equation is, correct? So here if you solve this equation, minus 1.108x is equal to 1.20. So the x here is minus 8.30%. See, if you see the x here itself, it denotes is that you borrow 8.3% of your total investment and invest 108.3% in your portfolio. So the portfolio investment should be 100 plus 8.3%, which is 108.3%, correct? So this says that minus 8.3 is you borrow 8.3% of the total investment and then do it accordingly. So this also, why you are wondering, it's I've put here plus is, so you can also mention it like this, because we have put in here 1 minus x, correct? 1 minus x, x is minus 8.3, so 100% minus 8.3%. This will give you the same result. Okay, so Sairam is asking x is equal to 460. See, in the first part, Sairam, it is x is equal to 461,820. Sorry, in the second part, which is the new investment. Okay, and for this, we are just calculating now the revised portfolio. Okay, revised portfolio, it says is that existing investment should be 108.3%. The risk-free investment should be 8.3% on a negative basis, correct? Hence, the risk-free comes out as 12 lakhs divided by 108.3% minus 12 lakhs minus 91,967. So this is the risk-free investment. So risk-free investment is negative. That means it is required to be borrowed, correct? If it is negative, that means it is required to be borrowed, and then put the total amount, which is 12 lakh plus this 91, which is 12 lakh 91 into the portfolio above. Okay, so we can write it like this, that the PM needs to borrow 91,967 and invest 12,91,967 in the portfolio above in the same proportion, correct? Between the different securities, Like, let's say the additional investment of 41.67 should go here, 8.33 should go here, likewise. Okay. I'm just projecting this solution for the moment. Okay. Now let us start with the next concept here. So there's a concept. So in this discussion, so basically in the entire portfolio management, there are different types of line: securities market line, capital market line, and characteristics line. Correct. I will be covering all these three lines in very detail in the next session. But for the moment, as of now, I'm just touching upon a very brief point on one of the lines. Okay, which is a characteristic line. Okay, students. So now listen very carefully. See what we have studied in Sharpe's index model, that what is a return for a security. The return is R is equal to, so I'm saying return on a security, let's say S, okay, is equal to alpha plus beta RM. Correct? This is what we have studied. And plus there is a unsystematic risk return as well, correct, which is we are denoting with EI. So I'm saying as of now, let's ignore this for the moment, correct. If you only see this, if we only take this value from the Sharpe's index model, this is what the gist of the characteristic line is. This is what will lead towards a characteristic line. Okay. Now here we studied that this is the alpha, and here we studied this is the beta. Okay. Now students, please note the beta calculation. We have already studied how to do the beta calculation as per the correlation and regression technique. There were two techniques. Now correlation, we already know it requires usage of the covariance, correlation coefficient, standard deviation. All those things are required in the correlation technique. But on the regression technique, you just need to write this formula, correct? This also we have studied: summation xy minus n x bar y bar divided by summation y bar square minus n y bar square. Correct? This is what we have studied in the regression formula. This is how beta is calculated. And now for calculating the alphas, correct, what we can take is, if you are already given on the return on securities, we can take just an average and minus beta RM average, which is the market return average. So what I've done is, this alpha, I have kept it on this side and reduced the return on security from the beta RM. Correct? Now, and both of these numbers are calculated on averages for the past data that is given. Now, why do we do that? Because see, for calculating alpha, what we have to do is we have to study the movement for the past, let's say 5 years, 10 years, or the historical data. After doing that, we have to just take the simple averages of both of them, and hence we have to calculate the alpha here. Okay. Now this we will better understand from the help of one question, which is the next question, question number 9. See, student, again I'm saying that the detailed part of all these lines I will cover in the next session, correct? So, but this is what we need as of now to build our concepts for the next part. Hence, this we are doing it now. Okay, so the question number 9 says, the return on stock A and market portfolio for a period of 6 years. That means they are talking about a historical data of last 6 years, and they are given us the returns as well as the market portfolio returns is as follows. And they are asking us to determine the characteristic line for stock A. Now, characteristic line, just now we saw that it is what? It is restricted to this, which is alpha plus beta RM. And alpha and beta has to be a constant number, correct? because as you would have studied in the earlier part, because in this one variable is an independent variable and one variable is a dependent variable. So this is an independent variable and this is a dependent variable. Correct. Both alphas and betas are constant. So I'm just putting here alphas and betas, both of them constant. Correct. RM, RS. This is independent variable. This is dependent variable. Okay, students. This we have also discussed in the regression technique as well, but again, I'm just brushing up the concepts here. So, characteristic line is given by return on A is equal to alpha of A plus beta of A multiplying with the market return. This is what the characteristic line is given. Now, beta is calculated through this formula xy minus n x bar y bar divided by summation of y bar square minus n y bar square. Correct? This is what is given into the question. And while studying the regression technique, I also told you that whatever comes in denominator, the below part of this, so which is y, it will be an independent variable. Correct? So that means the market related data will come in the denominator because market is always considered as independent. Okay. Now let us calculate the data. So years I am putting here. First of all, we are calculating the beta. Okay. So here is 1, 2, 3, 4, 5, and 6. So let's calculate let us put the values first. Return on A. Return on A is 12, 15, 11, 2, 10, minus 12. Okay, this is what I have put as a return. And similarly, return on market is given as 8, 12, 11, minus 4, 9.5, and minus 2. So the total for both of them is 38. And here it is 34.5. So hence, we can calculate the X bar here as 38 by 6, which is equal to 6.33. Y bar can be calculated as 34.5 divided by 6, which is equal to 5.75. Okay, Naveen, I will come to that query. Okay. So X bar, Y bar is 38 by 6 and 34.6. This is X bar, Y bar. And now what else is required? X bar, Y bar is done. Y bar is there and XY is also required. Correct. So let's calculate the XY here. So if let's say this is X and this is Y, XY we can multiply both of them. So first is 12 is 96, 15, 12, 180, 11, 11, 121, 2 minus 4 minus 8, 10, 9.5, 95, and 12 to plus 24 because both of them are negative. Let's add them. It comes as 508. And also, sorry, this is not Y bar here. Please note this correction in the formula. This is just Y square. Let me just check the formula that we have written in the earlier stage. Just a second. This is the regression technique formula that we have put here. So students, please note one correction actually here. In the regression technique, here it's not summation Y bar. This is my mistake. You can take Y square here. Okay. Y square minus N Y bar square. Okay, students. So here is what we are using this now. Okay, so this is summation y square. So we'll take y square here. Because y bar, x bar will come wherever you are multiplying it with n. Okay, so this thing always remember, because if you're taking averages, then there is no need to take a sum. We just multiply it with n, which is the number of observations. Okay, so 8 8 is 64, then 144, 121, 4 4 16, 90.25, and the last one is 224. So the total comes as 439.25. Okay, students. So this gives us the complete formula for beta. First of all, it is a summation of xy, which is 508, minus n is how much? 6. N is the number of observation, which is 6. X bar y bar is 6.33 multiplied by 5.75, whole divided by summation of y square is 439.25, as we have calculated. 439.25 minus n is again 6. Y bar square is 5.75 square. Okay, students. So this is the beta formula. And solving this beta, we will get 1.202. Okay, and now alpha will be the average of x and average of y adjusted for this, which is 6.33 minus 1.202 multiplied by y bar, which is 5.75. So the alpha comes as minus 0.58. Okay, and hence the characteristic line now will be, we can just replace the characteristic line with both these values. Is given as return on A will be minus 0.58. Now students, please tell me, what does the meaning of minus 0.58 means? If the return in market goes as 0, the stock will give you a return of negative 0.58. This is what does it means. So the return on stock will be negative to the extent of 0.58. Plus beta 1.202 multiplied with the return in market. This is what the line equation says. Okay, students. Now, second part, it is asking us to calculate the systematic and unsystematic risk of stock A. Now, for calculating the systematic and unsystematic risk, now students, please note one important point. See, unsystematic risk, as of now, we don't know how to calculate, correct? Because unsystematic risk always comes as a residual risk, or as a in the equation, if you see, always we calculate the total risk, and we also know how to calculate the systematic risk, because systematic risk, we can just simply take the beta square and multiply it with the variance of the market, correct? So hence, unsystematic risk, unless otherwise it is given in the question, we have to always calculate as a last variable. First, we have to calculate total systematic, reduce from total unsystematic, and we will calculate the unsystematic risk. Okay. Now that's what we are going to do here is, now the second part, let's first calculate the total risk. Now for calculating the total risk, we need to calculate the standard deviation of x here, correct? So x minus x bar square, correct? X minus x bar square, if we do, then it comes as 12 minus 38, and taking a square of that. Sorry, 12 minus 6.33. X bar is 6.33. So 12 minus 6.33 and taking a square of that. So this comes as 32.15, 75.17, 21.81, 18.75, 13.47 and 335.99. So the total here is 497.34. 4. And similarly, y minus y bar also we can calculate for calculating the standard deviation of market. Because for calculating the systematic risk, you need to have the standard deviation of market. So this comes as 5.06, which is nothing but 8 minus 5.75 and taking square of that. Okay, which is 5.06, then 39.06, 27.56, 95.06, 14.06, and last one is 60.06. While taking a total here, it comes as 240.86. Okay. Now we can just calculate the total risk. Total risk is for A security will be 497.34 divided by 6, taking this as a variance, and the risk will be standard deviation, which is a square root of variance. Okay, I think as of now there is no need to convert it into the standard deviation. We can just take the variance. So it comes as 82.89. This is what the variance is. And standard deviation of market square, which is the variance of market, will be 240.86 divided by 6. So this comes as 40.14. Hence, the systematic risk. See, beta we have already calculated. Beta was how much? 1.202 square multiplied by 40.14. This is already a variance of market, correct? This is already a variance of market, and hence the systematic risk comes out to be 57.99. Okay, students. So this is what the systematic risk is. Total risk we have already calculated. So the unsystematic risk will be. Students, please note while calculating the systematic, unsystematic, and total risk through this equation, always do all the operations on variance first. And then finally, once the answer comes, then take a square root. Okay. Don't do operations on the square rooted figure already. Always do all the operations, whether it is plus, minus, or whatever it is, on the total value, which I am also putting here. So the total risk, which is the variance, correct, is 82.89 minus 57.99. So this comes as 24.9. This is the unsystematic risk calculated in variance terms. Correct? This is not in standard deviation terms. This is calculated in the variance term. Okay, students. So please note down this. Then we'll go to the next part. Okay, students. So next part is Now let's come to some of the easy part. Very easy and very, I think all of you would have studied earlier this thing, which is the capital asset pricing model. Which is also called as CAPM. Okay, now what does this capital asset pricing model theory says is that to calculate a return on security, you have to take the risk-free return because that is any which way is given to you, irrespective of any risk you take, any risk you not take, this is going to come you. Sairam, for what you're asking for the practical example? Sairam is asking with the practical example. I think you're asking for the calculation part here, which I told you. Don't take the square root number. So if that is the question, then Sairam, what I'm saying is that don't take the standard deviation formula here and then do the plus minus like we did this minus, right? Always take the variance number and then do it like we have done it. So for example, 57.99 comes as in terms of square root 7.61, correct? So don't take 7.61 and do the plus minus for the formula here. Okay. Yeah. Now the capital asset pricing model says that risk-free rate of return plus beta. Sairam, please elaborate your question if this was not the question. Okay. Plus beta minus risk-free rate of return. Okay. Now, what does it say is that this is the minimum expectation that any investor would expect, irrespective of any level of given risk. Beta multiplying it with the risk premium. So, what is this? Return of market minus return on risk-free securities will give you a risk premium. So, this is nothing but the market is running on a higher return compared to risk-free securities. Why? Because risk-free securities essentially don't carry any risk, and hence the element of return on risk is not there because we always have heard it from the childhood: higher the risk, higher the return. Correct. So risk-free securities, since there is no risk, hence there is no element of return of risk in the risk-free securities. But RM, on the other hand, is the market portfolio which have all the risky assets and the non-risky assets. So all the risky assets and non-risky assets combined towards the risk, the return of market, which is RM, and hence this is what the risk premium is. Correct. So risk premium, but now how to adjust this risk premium towards calculating the return of security is where the beta comes into play. Correct. So beta will be multiplied to calculate the risk adjusted return for the capital asset pricing model. Now this is for a security. For a portfolio, the return is very simple. Instead of this, we have to take the beta of a portfolio. That's all. Correct? The beta of a portfolio we have already studied. It's just a weighted average beta, correct? We have already studied. This is just a weighted average beta, correct? And the entire concept given under the CAPM, capital asset pricing model, is also called as securities market line. Although this line we will cover in detail in the next session, okay, both securities market, capital market, and characteristic line. But I'm saying that this equation can be twisted to form the securities market line that we will study tomorrow, but in the next session. Okay. Okay. Now, Sairam is asking, okay, he was asking the practical example for systematic and unsystematic risk. Okay, Sairam. So let me go back to the previous session in which we discussed for a risk, there are two types. I'm just pausing in here to take Sairam's query. Just a second. Yeah. So in this slide, Sairam, if you would recall, we discussed that risks are categorized into two parts. One is the systematic and unsystematic risk. So systematic factors are those factors which are more generic, which are more macro in nature. For example, the interest rate, which is inversely proportional, because interest rate will influence all the prices in the market for all the shares, for all the bonds, for everything. Similarly, market trend, if it is a bullish or bearish trend, and the purchasing power, which is nothing but the inflation. Correct. So these are the generic and macro factors, and unsystematic, we discussed that these are specific to a business. For example, there is a business risk I'm carrying. For example, I'm running a business in which the operating margins are falling or they are very sharply increasing. So those are risks. Similarly, liquidity risk is if there is some debt that is present in my financing. There is a debt obligation that I have to service. Okay. So these things, unsystematic risk will only impact that company's stock. But systematic risk, once the factor moves in some direction, it will impact the stocks of all the companies. Okay. I hope this is what you are asking, Siren. Just see this part of the session again to understand it better. Okay. Now let us go to the question number 10. I hope it is visible. So the question number 10 says, Mr. Tempest has the following four shares: Oxyrin, Boxed, Square, and Ellipse. All of them, the beta is given and investment is also given. That means the proportion is given that how much they are invested. The risk-free return is 7 and the market return is 14. Determine the portfolio return and calculate the portfolio beta. Very, very, very easy question. So we can just mention, first of all, calculating the portfolio return. For that, I'm just mentioning all the companies' name: Boxed, Square, Ellipse. First, we'll put the betas that are given in the question: 0.45, 0.35, 1.15, and 1.85. So what is the investment that is there? 0.80, 1.50, 2.25, 4.50. The weights are given as 8.83, 16.57, 24.86, 49.74. These are the weights in percentages, correct? This is nothing but the 0.80 divided by the total here. So the total here investment is 9.05 and this total will be 100% always, correct? Now beta in two weights, which is the portfolio beta that will come out, is 0.0398, 0.058, 0.2859, and the last one comes as 0.9202. The total comes out as 1.303. So hence the portfolio beta (1.303). This is the first part of the question. And second part, first part is asking us to calculate the portfolio return. So for calculating any which way is the portfolio return, we have to calculate the portfolio beta. And now the portfolio return can be calculated as, what is the risk-free return? 7% plus portfolio beta is 1.303 multiplied by the market return of 14% minus 7%, which is the risk premium, correct? as per the CAPM. So hence the portfolio return is equal to 16.121 percentage. Very easy and very simple question. So let me take the questions first. Naveen is asking, sir, what is the weight when both cost and market price are given to calculate the portfolio beta? Using market price isn't misleading. That's right, Naveen. Actually, your question is bang on the point. See, if in question both the cost and market prices are given, then definitely we will go ahead with what question is asking us to solve the question with. Correct. If the question is saying to consider the cost price, we'll calculate the weights basis the cost price. But since in the current setup, in the current questions that we have solved, we are always given the current market prices. So the current market prices means that, see, the thing is that even all the times, whenever the market price change, your proportion in that security also keeps on adjusting in the overall portfolio. Correct. See, because in practical life, what happens is today, if you invest in any security at rupees 10, and basis that 10 rupees investment, you are converting your, let's say, 20% of the weight into that security. Correct. But tomorrow, if the price goes up and down, because of that, the weight also changes. Because all these calculations happens in every second. The return also gets changes every second. The prices also gets changed every second. The standard deviation also gets changed every second. The beta also gets changed every second. Correct. So it's constantly upgrading. Hence, Naveen, it in the question and in the general thought process also, market price is also as good as to calculate the percentages. Okay. And hence to calculate the portfolio beta. Now, Namita is saying, sir, in study made regression, no Y bar is given in the denominator, it's just sigma y square. Yes, Namita, I just corrected it in the first part of the session before the break. I told it to correct in the regression formula that I written yesterday. That was a mistake. So that I asked all of you to note and correct it. See here, I corrected it. Okay, Namita. So thanks for highlighting it, Namita. Okay, so actually it's not y bar, it's only summation y square. Because bar, again, I told that what is the proper way to remember is wherever you are putting y bar, x bar, there we will be using the n, which is the number of observations. Otherwise, we will be just doing the simple summation. Okay, students, now let us come back. I think we have already solved question number 10. Now let's go to the question number 11. Okay, now the question number 11 says the expected return on two stocks for a particular market are given in the following table. Now, student, this is also a very good question. It will cover almost all the things that we have studied, okay, in the CAPM as well as in the previous this thing. The market return is given aggressive, defensive. So there are three sets of series that are given to us. One is the market return, one is the aggressive, and one is the defensive stock. Now they are asking us to calculate the betas of two stock. Very easy, very simple. Now see, for calculating beta, we have studied correlation and regression technique. Correlation, there are formulas. Regression also, there are formulas. But if you notice this, these are only two data points, correct? One is 7%, 25% on market return. What is the aggressive and defensive stock it is going to be? So can we make use of both of them? Let's say beta of A, which is aggressive. So can we say that 40% minus 4% divided by change in the aggressive returns divided by the change in the market returns, correct? Which is 25% minus 7%. Okay. So this comes out as 40 minus 4 divided by 25 minus 2, which is 2. Okay. So beta for aggressive stock comes out to be 2. Similarly, beta for defensive stock will be 18 minus 9, 25% minus 7%. So this is how much? 9% divided by 18%, correct? So this is coming out to be 0.5. Hence the beta of defensive stock is 0.5. See, as the name also suggests, aggressive means which is higher on sensitivity, right? Which is true. Defensive means which is lower on sensitivity. I'm just telling you, which is 0.5. Yeah, Namita. So, Namita, that's what even I just now corrected. In the regression formula, it's just sigma ny square. That's all. Okay, let me just check the study material, Namita. Okay, so Namita, okay, just see, Namita, there are two, actually, the formula that has been used in the study material, if you divide both the numerator and denominator by n, you will arrive at the same formula that I have also written. Okay, Namita? So don't get confused between both the formulas because both the formulas are a bit different, but the result is same. In this case, if you see in the study material, Namita, if you divide both numerator and denominator by n, you will get the same result. Okay, Namita? There is no, because in study material, the y bar or the mean of the series is not used. That's because they have just multiplied already with n. Okay, Namita? So let's not confuse it. What I'm saying is that formula is totally different from this formula, but the result will be same because if the study material formula, if you divide both numerator and denominator by n, you will get the same result because if in the numerator, if you divide by n, so in the first part, the n and n will get cancelled. In the second part, after minus, so summation x by n and summation y by n, that will be x bar y bar. Okay. Okay, Namita. So either you follow the study material formula or you follow this. Correct? Whichever way it is okay. Okay, Namita. But the both formulas are used to calculate beta because the result is same and even one is derived from the another. Okay. I hope, Namita, this is clarifying. Okay, now coming back to this question. So we have calculated the betas part of the respective two stocks. Now, second is expected return of each stock if the market return is equally likely to be 77 or 25%. Now, equally likely means 50-50%. Okay. So there is a 50% chance that 7% will happen, 50% chance that 25% will happen. So the second part is, so the aggressive will be how much? 50% on 4 plus 50% on 40 is equal to 22%. Okay. This defensive will mean how much? 9%, 50% plus 18% into 50%. Correct. So this is 13.5%. So this is nothing but the simple average 4 plus 40 divided by 2 also you can do, or 50-50% because the equally likely it has been given. Third part, it is asking the securities market line if the risk-free rate is 7.5 and market return is equally likely to be 7 or 25. So this is also very simple. Securities market line is what? Nothing but the CAPM equation, right? Capital asset pricing model equation. So this is how we are going to calculate this in the third part. Now the securities market line, okay, will be 7.5% is fixed plus beta. Beta is one thing which will be a variable in this, correct? And now in this part we have to calculate that what is going to be the market return minus 7.5%. Correct? This is what the securities market line is going to be. Now to calculate the return of market, what we have to do is 50% of 7% plus 50% of 25%. Correct? Because both of them have a equally likely chance of 50-50%. Correct? So this comes as 16%. Okay, students. So the expected market return is 16%, and hence the SML, which is securities market line, can be rewritten as 7.5% plus beta into 16% minus 7.5%. This is what the securities market line is. Okay. Then last part, the alphas of the two stocks. The alpha that is asking us to calculate, we already have the betas, we already have the X bar, Y bar, and hence we can calculate the alphas. So let me rewrite the formula here. X alphas is equal to return on security average minus beta into return on market average, which is the RS by bar, RM by bar, RM bar and RS bar. Okay, so the aggressive alpha will be return on security. So 4 plus 40 divided by 2, which is 22%, or this we have already calculated above, 22% minus 2 into 16%. This comes as minus 10%. And defensive alpha is equal to 13.5% minus 0.5 into 16%. This is 5.5%. So these are the two alphas of both the stocks. Okay, students. So this is what the question number 10 was, 11th was. Okay. In a very good question, very light question to see. See, if you see, students, in this, we have not used any formula as such to calculate the beta. Even if you use the formula, that the result will be same. But since there are only two data sets, we have just seen that what is the movement divided by the what is the movement of market. That's all to calculate the beta. That's the only catch in this question. Rest all things are governed by the market. Let's go to the question number 12. Okay. Please explain the logic of alpha formula. So Namita, as we were discussing in our first part of the session, so the alpha, see what is alpha? In the Sharpe index model, in the first part of our session, we studied that alpha is the first time came into the picture in Sharpe index model. So alpha is even if the market return is 0, then what is the bare minimum return that an investor would expect? That is what is called as alpha. Okay. This is what is called as alpha. This is the bare minimum return expected by an investor, even if the market return goes as 0. Okay. And this is always a constant number basically in the equation. The question number 12, it says that the following information is available in respect of security X. Equilibrium rate is given, market return is given, 7% treasury bond is also given, covariance between market security and security return is also given, and coefficient of correlation is also given. You're required to determine the SD of the market return and the security return. So students, if you see in this is a typical formula based question in which we have to just put the values in a formula and see whatever is the missing end, we have to calculate it. But if you can understand from this, see what all things we are given in this. We are given the covariance, we are given the correlation coefficient, correct? And using the covariance and correlation coefficient formula, we can calculate the market standard deviation or security standard deviation, whatever is required, correct? So, but where is that logic? See, how can I arrive at either a standard deviation of market or standard deviation of a security? See, student, if you would recall, there is a formula of beta, correct? Covariance between security and market divided by standard deviation of market square. This is what the beta's formula was. Okay. Now, if you see, if we have beta, if we have already have this in the question, then we can easily find out this, correct, which is the standard deviation of market square. Now, to calculate beta, can we use CAPM in this? Definitely yes. Okay. So the CAPM formula says that the equilibrium rate 15% is equal to risk-free rate of return. See, risk-free rate of return, if I have to calculate here, it comes as 7% divided by 140. See, the question is drafted in such a manner that it says that 7% treasury bond trading at $140. So that means if they are trading at $140, what is the face value reasonable to be assumed here? We are assuming that the face value is 100 USD. If the face value is 100 USD, the 7% into 100 will be 7 USD is the interest. Correct? So hence 7 we are putting here, dividing it by 140, which is the current market price. So this will give us the current risk-free return percentage, which is coming out to be the 5%. Okay. You can assume it otherwise also, but whatever is the fair assumption to be made is what we have made here. 5% plus beta is what we want to know. 15% is the market rate and minus 5% is the risk-free rate of return that we have just now calculated. So this is using CAPM, using CAPM. Okay. This 15% is the equilibrium return. Equilibrium return means theoretical return. Theoretical return means it is calculated as per some kind of a formula, which is CAPM. So now solving this, beta will give us as 1. Okay, students. Now, if you replace 1 in the above formula, 1 is equal to covariance between security and market is 225. Standard deviation of market square, here we can put. Hence, the standard deviation of market is 225 under root, which is equal to 15%. So the standard deviation of market is coming as 15%. And also, we know that R, which is correlation coefficient, is covariance between market and security, multiplying it with the standard deviation of, dividing it by the standard deviation of market and standard deviation of security. This is what is R is given. The formula of R is this, correct? So R we already know is given in the question, 0.75. Covariance is given as 225 divided by 15 is what we have already calculated, and this is what we can take out in the formula. So that means standard deviation of the security X comes out as 225 divided by 15 into 0.75. So this is coming out to be 20%. The standard deviation of security is 20%. Now, students, please note, standard deviation of a security is 20%. Standard deviation of market is 15%. Beta is 1. How is that possible? Students, please note this question or this conclusion from my side. If beta is equal to 1, how come with the standard deviation of market, which is at 15%, the standard deviation of security is 20%? Is this possible? Anyone can attempt this question. Why? I'm just trying to ask that why in this case, if beta is 1, standard deviation of market and standard deviation of security is not equal. First of all, is this right? What is getting calculated here? Okay, Namita is saying, sir, why cannot we take the risk-free rate as 7%? Namita, you can take that, but the question, the way it is framed is, it says that it is trading at. If these words were not there, then that assumption of 7% is very reasonable to be taken. But since question is saying that trading at, we cannot disregard this information, correct? We have to adjust this information into our formulas. And trading at means that definitely it's not the face value, it's the current market price. Then what is the reasonable face value to be assumed here? It's 100 USD, correct? Hence we have taken 7 by 140. Oh wow, I'm getting beautiful answers. Naveen is saying unsystematic risk. Naveen, bang on the point. I think you have understood the entire concept, because the only difference between standard deviation of X and standard deviation of market is unsystematic risk. I hope now it is clear to all of you. See, beta is equal to 1 does not mean that there is no unsystematic risk. Okay. If beta is equal to 1, it means that the systematic risk is as good as the market risk. But apart from that, there is an unsystematic risk also sitting in the model. Okay. So Naveen, you are right. This is the unsystematic risk only. Okay. So this 15, so the security carries that unsystematic risk, but the market does not carry the unsystematic risk. Okay. Okay, students. So yeah, I hope till here it is all the things are clear. Okay. Meanwhile, it saves. So now let us come to the arbitrage. Arbitrage pricing theory. Okay. Now, what does this theory means? See, arbitrage pricing theory says that in CAPM there is only a one factor, correct? In CAPM there is only a one factor which says that there is a risk adjusted return on account of beta, which is the market risk premium. Now, what does arbitrage pricing theory says is that arbitrage pricing theory have a very simple formula. R is equal to RF plus alpha 1 beta 1 alpha 2 beta 2. Sorry, this is not alpha, the factor basically n and beta n. Okay. Now it says that there are a lot of other reasons for the return to be influenced apart from the risk premium. Okay. Now, for example, there is an inflation that can also impact the prices. Now, this beta 1 is the sensitivity of returns in relation to the inflation, not in relation to the market premium or the market return. Correct? Because what is the other beta that we have studied till now in CAPM is it is the sensitivity of returns of a security in relation to that of a market return. Correct? But this beta in arbitrage pricing theory is in relation to that factor. Now, what is that factor? It can be market premium. It can be any other thing. It can be inflation. It can be the GDP data. It can be anything. Okay. So in this, we assume that there are more than one factor that influences the prices. And this part, these symbols denotes that these are the risk premiums for that factor. Okay, students. So this is the risk premium for that factor. Let us go to the question number 13. Okay, now what does question number 13 says? We'll just try to see from this question. Mr. X owns a portfolio with the following characteristics. Okay. Now he owns a portfolio already, and these are the characteristics. So factor one, factor two, and expected return. So factor one and factor two are two different factors. It can be market premium, it can be the inflation, it can be the GDP, it can be anything. Correct. And they say that the beta sensitivity means beta. So beta for factor A is this, security B is this, and the returns are also given. Risk-free security, what is the beta? Risk-free security, if you see, it's 0 only here. Correct. Because risk-free is not related to any factor. Correct. Because it's all riskless. It is assumed that the security returns are generated by a two-factor model, which is nothing but the arbitrage pricing theory, APT. Now it is asking if Mr. X has rupees 1 lakh to invest and sells short of 50,000 of security B. Sells short means he sells it and he receives the amount of 50,000 and purchases 1 lakh 50. So he has 1 lakh in his pocket. From that 1 lakh, first of all, he's selling 50,000 and he is again realizing 50. That entire 150 is investing in the security A. That means he's divesting security B and he's investing that amount into the security A. Okay. What is the sensitivity of Mr. X's portfolio to the two factors? Okay. Now they are asking that portfolio, what is formed, what is the sensitivity of that? That means what is the portfolio beta of that? Simple. Of both the factors. Correct. Now, first part, we are calculating the weights first. So A and B, there are two securities. A's weight will be plus 1.5 and B's weight will be minus 0.5. I hope this is understood. Because 50,000 is invested, is divested minus 50,000 plus 1,50,000. So the weights becomes plus 1.5 and minus 0.5. Now factor 1 is given as 0.8 and 1.5. 0.8, 1.5. So the weighted factor 1 is 1.2, which is 0.8 multiplied by 1.5, and 1.5 multiplied by 0.5 comes as minus 0.75. So the total comes out to be 0.45. Correct? Similarly, factor 2. Okay. So the factor 2 is 0.60, 1.2, weighted amount comes as 0.90 minus 0.60, and the total is 0.30. So the portfolio that is formed by doing this operation of divesting 50,000 and investing 1,50,000 in the portfolio makes the factor 1 sensitivity as 0.45 and factor 2 sensitivity as 0.30. Okay. Now what is the second part of the question? It says that if Mr. X borrows 1 lakh at the risk-free rate and invests the amount he borrows along with the original amount of 1 lakh in the security A and B in the same proportion as described in part 1, what is the sensitivity of the portfolio? Now it is complexing the situation. Now what they are saying is, see, 1 lakh he originally had, another 1 lakh he is taking. Now in totality he has 2 lakh. 1 lakh that he has taken is from the risk-free securities, and that 2 lakh again in the same proportion of ones. The proportion of 1 was 1.5 and minus 0.5. So that 2 lakh, again he's saying 1.5 times he will invest this. So 2 lakh into 1.5 becomes 3 lakh. And minus 0.5 becomes 1 lakh. Correct? So the revised weights comes as, this is security A, B, and risk-free. Now I'm putting 3 here. So minus 1 lakh he will put here. So minus 1 lakh he gets from, the 1 lakh he gets from the risk-free borrowing. 1 lakh he already had. So 2 lakh multiplied by 1.5, which is the original proportion, correct? So this comes out to be 3 lakh here, which is 2 into 1.5, correct? And here it comes as 1 lakh negative. correct? So I'm just revising the weights here. It comes as 3 minus 1 minus 1. Okay. We will just multiply this with the respective factor. So factor 1 is 0.80, 1.5 and 0. So this comes as the weighted amount of 2.4 minus 1.5 and 0. So this is 0.90 in totality, correct? And factor 2 coming out to be 0.60, 1.2 and 0, correct? So the weighted factor 2 comes as 0.60 multiplied by 3. So 1.8 minus 1.20, and the total is 0.60. Now students, if you see what this investor is doing is, this investor is increasing his risk profile, correct? Because he's borrowing from the risk-free security and he's investing into the higher risk securities, correct? He's borrowing from the risk-free investments by divesting it, and then he's again investing in the risky securities, and hence overall his portfolio risk is getting increased. Okay. Now let us go to the third part. What is the expected return premium for factor 2? So the premium they are asking here this. Okay. Now see, these are two securities data that are given to us. Let us first write the equation on return for both of them. See, because we are already given that 15% is the expected return and 20% is the expected return. Can I, using the arbitrage pricing theory, can I write this? 15% is equal to 10% is the risk-free plus 0.80 is the factor for 1 plus 0.60 is the factor for 2, correct? Similarly, for 20%, which is the security B, is equal to 10% plus the factor for the beta for 1 is this, and the beta is 1.2. Okay. Now, this is using the arbitrage pricing theory that we have put both the equations here. And what we can do is, using the equation solving technique, we can just multiply the equation 1 by 2 and subtract it. Because if you see this 0.60, 1.2, if we multiply this entire equation 1, this entire equation 1 by 2 and subtract it from 2, then we can get the equation solving here. So what I'm doing is multiplying equation 1 by 2 and subtracting it from equation 2. Okay. So 20% is equal to 10%. I'm first writing the equation 2 as is. Okay. And minus. So this into 2 is 30%, 20%. Sorry, this is 1.60, 1.20, this. And this all will be reduced or subtracted. Correct? Okay. So this will give us minus 10% is equal to minus 10%. 1.5 minus 1.6 is minus 0.10 for factor 1, and this is 0. Correct? Now, if we can solve this further, this will be cancelled, and the premium for factor 1 is 0. Now, if the premium for factor 1 is 0, we can put that in the equation 1 and find out. So 15 minus 10 divided by 0.60, correct? So this comes as 8.33 percentage. So this is the factor for risk premium for the second factor. So basically the second factor sensitivity, the risk premium here is coming as 8.33 percentage. Okay, so Namita is asking, sir, in question it is not given that how much amount of security B he is holding. So how can we assume in second part that he is selling it for 1 lakh? Okay, Namita, let me answer that. So Namita, if you go to the question and see in the first part of the question, they have mentioned that initially he has a sum of 1 lakh, and what second step he does is he sells short 50,000 for security B, and he takes 50,000 from that selling short. Now he has total 1,50,000 and he is investing entire 1,50,000 into security A. Correct. Now, what is the proportion here? We saw that proportion is plus 1.5 and minus 0.5. Correct. That is the proportion in one. Now, if you read carefully the second part, Namita, it says that if Mr. X borrows 1 lakh, okay, so it is saying that he will further borrow 1 lakh at the risk-free rate and invest the amount he borrows along with the original amount of 1 lakh. Because in the starting of the question, it said that it has 1 lakh, right? So now 1 lakh he borrows, 1 lakh he already had. Now how much he had? 2 lakh, correct? Now 2 lakh is what he has. And he's saying that he invests in security A and B in the same proportion as described in part 1 above. This is what the main line is. Okay, so he's saying that now that entire 2 lakh, he will invest in security A and B in the same proportion that was there in part A. Now 2 lakh for 1.5 comes out as how much? 3 lakhs. And 2 lakh multiplied by negative 0.5, it comes out as how much? 1 lakh negative. Correct? Okay. So this is how the proportion has come out of 1 lakh. Okay, Namita? So this is the question on arbitrage pricing theory. Yeah. Okay, students. Now let me go back to the first slide. Okay. Let me go back to the start of the session where I said that there are three points in the entire discussion that we are trying to answer. One is that which security. Now we all of us know that how to evaluate a security through risk and return. We have studied the different types of theories as well: Markowitz portfolio theory, then Sharpe's index model, capital asset pricing model, and the arbitrage pricing theory. What amount is also given under the Sharpe's index model, which we are going to study in our next session. But before that, there is one more thing on the evaluation of portfolios. Okay, which is the what are the evaluation techniques of a portfolio? Once the portfolio is formed, then how are we going to evaluate that, whether that portfolio is performing good or performing not good? Okay, now let us go to this part of the discussion. Yeah, which is the portfolio evaluation Okay, techniques. So students, till now we have studied different types of, there are two types of risk: systematic, unsystematic. Total, if we combine them, makes the total risk, correct? So the first ratio is based on the total risk. Now, what do you feel would be a better metric to evaluate whether a portfolio is good or not? See, one thing that we did in our previous discussion was that we were saying that if we take the return in numerator and divided it by the risk, we will get to know that what is the per unit return that we are getting for 1 unit of risk, correct? So for example, the return is 10 and the risk is 5. That means for every 1 unit of risk, we are getting 2 times of returns, correct? And if you remember in question number 6, we use the same logic only to see that which security is better. So the same thing is what Sharpe has also said. So this is called as Sharpe's ratio. But what he says is that instead of taking the entire return, let us only take that what is the excess return over the risk-free return. Because see, risk-free return is so any which way is guaranteed to all the investors. Because risk-free return is the guaranteed return, is the minimum return that any investor can expect. So why are we taking the total return? We should take only the excess return over the risk-free return. Okay. So he said that take return on a security minus risk-free return. This is what? This is a risk premium on that security or on that portfolio. So RI means return on the portfolio here, and divided it by the standard deviation of I, or I am saying standard deviation of I like this. Okay. I'm just putting only standard deviation symbol here so that there is no confusion. Okay. So he's saying that what is the excess risk, or it is the excess return over risk-free return that we are earning for 1 unit of risk being undertaken. If the Sharpe ratio is higher, that means the portfolio is better, because for a lower risk, you are getting a higher return. Correct? So higher the ratio, higher Sharpe ratio, better it is. Lower Sharpe ratio. So lower Sharpe ratio means that the portfolio is not better. Portfolio is not good. Correct? Portfolio is not optimum or better, I can say, as of now. Okay. This is what the Sharpe ratio is. Let me take the question. Namita is asking, sir, by saying multiple factor, we are meaning that CAPM for A. Are we mean that CAPM for A? Multiple factor. Okay. So this multiple factor is for the arbitrage pricing model, Namita. And this is beyond CAPM actually, because CAPM only considers only one factor, as I told you, right? So apart from that, there are a lot of other macroeconomic factors that affect the returns as per the arbitrage pricing theory. And this is what, so this one and this two are the risk premium for those respective factors. Okay. So that means there are multiple factors that are there into the arbitrage pricing theory. Okay. It is very much different from CAPM, because CAPM, it only considers only one factor, which is the market risk premium. Correct? Yeah. So this is what the Sharpe's ratio is. Coming back onto the evaluation technique. The second technique which is there is Treynor ratio. Okay, now students, please see what Treynor says is that we will take in numerator the excess return over risk-free return. That is okay, because this is a metric that we will come to know that what is the excess return that we are getting over and above the risk-free return. But he says that instead of dividing it with the total risk, let us only divide it with the unsystematic risk. Correct? Because he's saying that systematic risk is still there. Why to see it on a total risk kind of a thing? We will just see only on unsystematic risk, and unsystematic risk is calculated using a factor called beta. So he's saying, let's see what is per 1 unit of beta, what is the excess return that we are getting. Okay. So here standard deviation is the total risk, and here beta is used to calculate the systematic risk. So hence it is only a part of the total risk. So I am putting notations here. RI is equal to return on investment, return on portfolio, I can say. RF is equal to risk free return, and BI is equal to beta of portfolio. Okay. And standard deviation is equal to total risk, or I can say SD, standard deviation of portfolio. Okay, students. So as of now, there is one more. Okay, so this is what Sharpe's and Treynor's evaluation technique says, and both of them have different logics and different perspective to view how to evaluate a portfolio. Correct? Okay, now let us go to the question number 14. Okay, students. So the question number 14 says that, now this is a very good question. Suppose the economy A is growing rapidly and you are managing a global equity fund, and so far you have invested only in developed country stocks only. So currently the question is saying it's nothing but two kinds of investment. We are currently developing in developed country stocks. Now I've decided to add the stocks of economy A to your portfolio, which is okay. The table below shows the expected rate of returns, which is the returns, standard deviations, and correlation coefficients. Okay. All the three statistics are given. All estimates are for aggregate stock market of developed countries and stock market of economy A. Now, what question is trying to say is that, because we might think, because we can only invest in one security, correct? But what they are saying is that these estimates are for the all the economy put together for aggregate stock market, which is what we need also. So the developed country stock is 10, and economy is 15 is the return, and the risk also you can see. So students, if you note here, the developed country stock is giving you a lesser return and the risk is also lesser, but economy A, the return is higher and the risk is also higher. That's how we should analyze the initial thoughts on the question. Now the correlation coefficient between both of them, which is R for us, is given as 0.30. Okay. Now they are saying that risk-free rate of return is 3%. You are required to determine, number one is, what percentage of your portfolio should you allocate to the stocks of economy A? Because the entire question is saying that we are in the process of including economy A into our portfolio, correct? So first question is very valid point. What percentage are you planning to allocate to economy A if you want to increase the expected rate of return on your portfolio by 0.5 percentage? Now, what is the current expected rate? It is 10%. And what is the question asking us to increase it to? By 0.5 percentage. So that means total expected rate, the question is asking us to make it as 10.5. Okay. Now solving A, let us assume, let the percentage investment Hence stock A to be X. Okay. Now, if we take X, so 15% multiplying it with by X plus 10% multiplying it by 1 minus X. So if X percentage we are investing in economy A, 1 minus X we will invest in developed countries should be equal to 10.50 percentage. This is what a very simple equation is. We are just taking the proportion and multiplying it with the returns. So here it comes as 15x plus 10x minus 10 is equal to 10.5. And so this comes as 25x is equal to 20.5. Okay. And hence the x is, oh, sorry, I did one thing wrong. This is actually minus and this is plus. The signs while opening the brackets. Yeah. And hence the x comes out to be 10.5 minus 10 divided by 5. So hence x is equal to 10%. So as per the equation or as per the condition given, 10% of our total investment of the portfolio should be as investment in economy A. Correct? So we can conclude here, invest 10% in economy A so that the total return comes as 10.5%. Okay. Now, the second part of the question says that what will be the standard deviation of your portfolio, assuming that the stocks of economy A are included in the portfolio as calculated above. So second part of the question is asking us to calculate the standard deviation, which is risk. So portfolio risk, if we go ahead with the proportion that we have calculated in part A. So part B, overall variance. Now students, in this, what information is given us that suits whether we should apply MPT, which is Markowitz portfolio theory, or we should apply the Sharpe's index model. So can anyone attempt this question? What I'm asking is that basis the given information here, can we apply the Markowitz portfolio theory, which is MPT, or the Sharpe's index model? Because now we have studied both of them. It would be good if all of you answers this question, because this is very straightforward. This is the data given. We have seen that in which cases we have to apply the MPT and in which cases we have to apply the Sharpe's index model. Okay. Okay, so let me take it. Meanwhile, if any one of you is responding. So we have studied that SIM, for calculating the SIM, we need beta, we need standard deviation of market, and we need standard deviation of the unsystematic risk. Correct? All these things are not there in this. Correct? The standard deviation of market, E and beta is not there. Hence, we will follow the MPT only, which is the Markowitz portfolio theory. And this is a two securities case. Hence, we will just put the that weight 1, weight 2 square, the same formula. So now if I put it, so weight 1 square, standard deviation 1 square, weight 2 square, standard deviation 2 square, plus 2 times weight 1, weight 2, standard deviation 1, standard deviation 2, and correlation coefficient between 1 and 2. So this is what the two securities model is given. Perfect. So Namita, thank you for answering. Empty as R is given. Perfect, Namita. Okay. Now overall variance will be, so weight 1, standard deviation 1 square. Now we have standard deviation of 1 square as 16, 2 as 30, correct? So 16 square and weight 1 is how much? We have calculated here. So 10% is in the country economy A and 90% in the developed country. So 0.9 square, correct? Multiplying by 0.90 square. Similarly, weight 2, sorry, standard deviation of 2 is 30. So 30 square multiplying by 0.10 square plus 2 times 0.10, 0.90, okay, and then the 16 multiplied by 30 multiplied by correlation coefficient, which is given as 0.30. It's just a simple application of the formula that we have studied. So the variance comes out to be, if we solve this, 242.29, and hence the standard deviation 242.29 is equal to 15.56 percentage. So this is what the overall standard deviation or the overall portfolio risk is. Now students, please note the current risk was how much? 16. Correct? If you see the situation, the investor has invested all the amount in developed country. He was earning a return of 10% with a risk of 16%. Correct? But now if you see, he's earning a return of 10.5. I'm just explaining something here. So 10.5 he's earning as a return and 15.56% is the risk. So this is a new situation, old situation. Old situation, he was earning 10% with a 16% of risk. Which one do you think is better? This is what I'm trying to explain here. With all these operations, what this investor has did is, he has increased his returns and he has reduced the risk. This is return. This is risk. And this is what the portfolio manager is supposed to do. Higher the return and lower the risk. Now, how he's been able to do this? Correct. See, because although the stocks, the return is increased in economy A, but the risk is also higher. Correct. But what he is observing is, since there is a lesser correlation between both of them, it will bring down the overall risk, because if you see as per the mathematical formula also, it just multiplies it by 0.30. So it will take only 0.30 part of the total risk. So this is what a major deciding factor is, which is the correlation coefficient while devising the proportion. Correct? Because in the previous session also we have studied a lot of things around it. So this is what I'm trying to say. Now this is better, we know. Correct? So the third part of the question is asking what? Let us see. Also show how well the fund will be compensated for the risk undertaken due to inclusion of stocks of economy A in the portfolio. Now what it is asking us is that since you induced the economy A stock, the risk is higher. And you have to showcase it how well it has been, or how well this decision has been. We have to validate this decision. Okay. Because as per what it is shown here, we know that it is better. Correct. Sorry, this is C part. So if you see students, now it is revolving around the Sharpe's ratio. Correct. Because if we calculate the Sharpe ratio, it will give us that how well we are compensated for the risk undertaken in terms of a return. Correct. So let us calculate Sharpe's ratio for both the pre and post change. Correct. Sharpe's ratio. First of all, let us write the formula is given by the return on portfolio minus risk-free rate of return divided by standard deviation of the portfolio. Correct? This is what Sharpe ratio says. So if we say that earlier the entire investment was in the developed country, correct? So this was 10 minus 3 divided by 16, correct? Because 10 was the return on the developed country stock, 3 is the risk-free rate of return, and 16 is the total risk. This, if you solve it, comes as 0.4375. And on the other hand, the portfolio, newly formed portfolio, is coming as 10.5 minus 3 divided by what is the risk? 15.56. So this is coming out to be 0.4820. That means the Sharpe's ratio after this 10% investment in stock A is higher. So the Sharpe's ratio is improved by 0.04. Hence, it is better to invest. Correct? Because for a higher, because that is what the question is asking you, that how well the fund is compensated. Definitely, the fund is compensated because for the same level of, for getting the higher return, the higher risk is there, and hence the Sharpe ratio still is getting better because less risk is getting reduced and return is getting to be higher. Okay, students? Yeah. Now there is the last technique left before moving to the next question. There is a last technique left called this is also a portfolio technique only. This is called as Jensen's alpha. See, students, if you see this, we have already studied in the concepts itself. If in the first page, if you go and see, I have mentioned or touched here two things. One is the actual return and one is the expected return. Correct? Because actual return is what has actually happened and expected is what is our expectation. Correct? So Jensen's alpha's theory is also based around this only, where it is said that, just a second. Yeah. So Jensen's alpha story, the theory is also based around this only, where the conclusion is very simple that we have to compare the actual return with the expected return minus expected return. Okay, students, if we do this, then we know that if there is some expected return, and if the actual return is better than the expected return, it means that the portfolio is better. Correct? Because actually you are getting higher than what you expected is definitely better. If actual return is as good as expected return, so let me put it, actual return higher than expected return, then the portfolio created is better, and what is advisable is to buy or invest in that portfolio. Correct? If the actual return is equal to the expected return, the portfolio is stagnant and the decision is to hold. We can hold the portfolio. But if the actual return is lesser than the expected return, the portfolio is not any which way is better, and hence we can sell it. The decision is to sell. Okay, this is what Jensen's alpha says, that you have to compare the actual return with the expected return to arrive at that what decision you want to make. Okay, students. So with this, the portfolio evaluation techniques is over. Now we'll practice some more questions to understand it better. Now let me take Namita's question. Namita is saying, sir, please explain two-part logic of why risk is lower. Okay. See, Namita, as you can see that as per the formula and even as per the theory, it says that how the risk, how the overall risk will be calculated. We will just take the weights and multiply the respective variances. No, we have to apply this formula which says that weight 1 square, risk 1 square. Similarly, at the end, if you see, this is the factor due to which the risk actually varies. Okay, there are all these factors, it varies, but because of this R12, the technical part of the equation is this. See, what is this? This is the correlation coefficient that we studied, because it will measure the degree and extent to which if this moves, then how second will move. Correct. So basically, it says that if it is 0.30, that means if a developed country stock is going up by 10%, okay, the stocks of economy A will go up by only 3%. So both of them will move at a 0.30 kind of a correlation coefficient range. Both of them will move in the same direction because it's a plus sign. But if one increases, second one will increase only to the extent of 0.30. And this is the reason. This is the reason, since R is closer to 0.30, the risk is getting reduced. Okay, because if you put any other value other than 0.30, let's say you put 0.70 here, the risk will be higher. Correct. And hence, this is what the technique that we have studied is to make a perfect riskless portfolio. The R should be -1. Then only it would be riskless portfolio. Then only you are able to eliminate all the unsystematic risk. Still, the systematic risk will be there. Okay, students. So this is what the logic or the mathematical explanation of R is. Because of that, the overall risk is getting reduced. Okay. Now, actually, the next question will take a lot of time to be solved. So hence, let us take some 5 minutes to revise the entire concepts and then we can wrap it up. So we'll start with the portfolio management, in which we said that there are 3 questions that we try to see. Now, first, from security standpoint and from the portfolio standpoint, we always evaluate it in the form of 2 characteristics. One is return and one is risk. For both of them, we have seen that there are 2 scenarios. One is historical data and one is futuristic data. Because in historical, it will be the number of observations, and in futuristic, it will be the probability that will be used. And then we also studied the risk. Now, risk we have divided into 2 parts. One is the systematic risk, which are the common factors, macro factors, generic factors that impact all the stocks in the economy. And one is the unsystematic risk, which only impacts the specific stocks, which is a business related, which is a company related risk. And we have also seen that the diversification can happen with the increase in number of securities, but still the systematic risk will still be there, because systematic risk is there in all the securities. Unsystematic risk you can eliminate. This is what we have studied in the previous question also. And we also studied what is the meaning of variance and covariance. Using covariance, we can calculate the correlation coefficient, which is the main factor for determining that how the overall variance will shape out, as we have just discussed now. And apart from that, we then discussed on how to calculate, because beta is one of the most important factor in the systematic risk that we have seen. And we have seen that it is denoted by the sensitivity of factors. And there are 2 ways of calculating it: correlation and regression technique. Both of them we studied how and what is the relevance of it. Now, once the beta is done, then we started coming on to the portfolio, how to calculate the portfolio return and portfolio risk. Portfolio return is just the weighted average of the returns multiplied by the weights. And the risk in case of modern Markowitz portfolio theory or modern portfolio theory, we studied that we have to bifurcate into two parts, two securities and more than two securities. Two securities we covered in the previous session with this formula, and just now we applied this formula in the question. More than two securities can be based on the matrix approach that we have studied today. Okay, and apart from that, we studied the Sharpe's index model. So this is the matrix approach that we studied today, correct? Then we studied on the Sharpe's index model, where we said that the return and risk are based on a single index, which is a market index, rather than finding out the covariances, rather than finding out the correlation coefficient between the securities. You just measure your security in relation to the market index. Hence, it is called as single index model. So in both risk and return, we have seen there are two types of factors, macro and micro, to calculate the risk and return. Similarly, for portfolio, it's just a weighted average of returns. And for risk, we again bifurcated. For the systematic risk also, we take the weighted average, and the unsystematic also, we take the weighted average. Then we studied the capital asset pricing model, which is CAPM, in which we said that the risk, the return is based on two things. One is the risk-free return, which is the minimum guaranteed expected return an investor would expect, and the risk premium, correct, which is RM minus RF. And similarly, so the lines, again, I'm saying we will cover in the next session, all the types of lines. Briefly, we have touched upon. Arbitrage pricing theory, we studied that apart from the risk premium, there are other factors also that impact the pricing, correct? Now, Namita is asking a question on APT only. Sir, in APT theory, we are adding beta of different factors like GDP and inflation, or is it like one factor beta upon n terms? No. So if you see the formula, I think arbitrage pricing theory is before question number 13. So if we see, this is the formula. In this, what we take is we just take the risk-free return plus this is the risk factor for factor number 1. This is the risk premium for factor number 2. This is the risk premium for factor number 3. And hence it is. There is no division here. And this is the beta for this factor. This beta 2 is for factor 2. Similarly, beta 3 is for factor 3. Okay. Now, for example, in this question only, 0.80 is beta of security A for factor 1. 0.60 is beta of security A for factor 2. Correct? And both of them will have a risk premium also. Are we adding beta of different factors? No, we don't add. We just multiply it first with the factor and then we add it. Okay, Namita? And Saran, sigma, we write I is equal to 1 to n. What does this mean? Okay. So, Namita, so this is a common notation. I is equal to 1 to n means that for all the observations from 1 to n, now n can be anything. It can be 5, it can be 6, it can be 10, it can be 20, it can be 100, or even it can be 2 also. So for all the observations up to n, you have to do the same operation and then take a summation of it. Then take a sum of it. That's all. That's what this notation means. This is a standard mathematical or statistical notation. So with this, today's session comes to an end, and now I would like to hand over to Ashish sir for the concluding remarks. Thank you. Yes, sir, you're audible.
Am I audible?
Yes, sir, you're audible.
Okay. Your session was very good and it was very knowledgeable because your manner of presentation was very unique. Even I have to listen to your lecture very carefully. While going through the queries, so one or two queries I will like to discuss with the student. One query was how to present answer in the exam. This is a very common doubt, student. Please remember, because what I have observed even on a YouTube, many faculties are claiming that you should present answer in this manner. They are showing the sheets at the. My observation is that, see, whenever you attempt any question, please remember in the examination, see, marks are for the steps. Marks are for steps, and that are for your computations. Okay. Suppose if in a one step, there are 4 steps are there, 4 computations are there, and their final computation is fifth number. So for 4 marks, the computation will be 1 marks like that. So for 1 mark, how you are calculating, it is not that important, but you can present how you have reached to this figure. So you know to say that 2 into 2 is equal to 4. You cannot need to expand that much, but reasonable working notes are suffice enough. Okay, so don't worry, don't you, because if you are, because you are reaching on the figure fifth by adding these 4 figures. So then how you have arrived these 4 figures is more important. Okay, now too much depth in the 4 figure is does not is irrelevant. Now, there was a question of Naveen Prakash regarding seventh number, question number 7, part 3, book exercise. Naveen, I could not get exactly what you want to say. There was what have you discussed?
No, sir. We will discuss in the next session. This 7 part 3, we will discuss in the next session.
Okay, no problem then. Then Naveen Prakash has asked, sir, which weights we should use in computing the weighted beta, that is market weights or cost price. There was, frankly speaking, I was in traveling at that time because I have come to the office. So what was your view on this? In this?
Yes, sir. So I said that because market price, first of all, we should go with what question is saying, if it is cost or market price. But why market price is given? Because this question was saying that why market price is misleading. So I was telling that constantly the weight proportions keeps on changing. In real life also, constantly, if we invested 10 rupees, tomorrow it becomes 12, the proportion will automatically increase and all the factors gets calculated accordingly. So hence, we should go with the quotient or else with the market price.
Yes, of course, I 100% agree with you. Now there is one more factor here is that, student, please note, market price actually reflects the risk perception, because risk is nothing but it is kind of a perception also. In a portfolio management, our behavioral aspect is very important. Okay, so market price also reflects the behavior of the investor. So that's why we should always use the current price, because normally these are used for the future prospects. What you have done, that is past, but this is for use the future investment. So it is always better you use the market price there. So thanks a lot, Divas, and thanks, student, for your questions that you have sent. Now, as we normally said that if you have any query, you can send us to Divas. Can you just on your iPad?
Yes, sir. Yes, sir.
And just jot down our email ID and my telephone number that I am spelling.
Yes, sir. Yes, sir. Just a second.
Okay, no problem. I do one thing. I share on my, if possible.
No, I just done.
Okay. No problem.
Yeah. Just coming.
No problem. Yeah.
Yes, sir.
Very nice. Just write down SFM dash final @ICA.in. Okay, student, you can send your queries as this email ID, and you please note down my mobile this is landline number 0120 3045 956. Okay, students. So this is a number that 0120 is STD code. Okay, because our office is in Noida, and you can contact me over the telephone if you have any doubt. So student, thanks a lot. We shall meet day after tomorrow. Okay, we shall continue this portfolio management, and Divas sir will take the class. Thank you, Divas. Thanks a lot.
Thank you, sir. Thank you
for your efforts. Okay, students, have a nice day. Okay, Divas.
Thank you.